Canada's annual rate of inflation slowed for a fourth straight month. We know that April CPI came in at 2.7%. It's a figure that we haven't seen this low since 2021. So what might this all mean for the impending Bank of Canada rate decision early next month? And how could it impact Canada's bond markets more broadly for the second half of this year? Joining me for a look at the factors influencing the bond market landscape are Fidelity portfolio managers, Tella and Lee Ormiston. Welcome to you both. Great to see you. How are you?
Good, thank you. Good to see you too.
Great to have you.
Great, thank you.
Here. Thanks, Lee. We'll invite everyone here to send their questions in for Sri. Also for Lee, we'll take those questions for the next 30 minutes or so. Lee, I'm going to start with you if you don't mind. I think a lot of us focus on the Fed and the US rate story and what will and won't happen on that side of things. As it happens, our country, along with a lot of countries around the world, are right on the precipice or walking that tightrope of, is it time to cut? The EU has given us some promises, or it looks like close to promises. What do you think of the international landscape for, say, developed markets that we're expecting cuts from at some point, ex-US?
Yeah, I mean, that's right. So higher rates are definitely having an effect. We're seeing economies slow. We're seeing inflation come down across the world, probably more so than we are in the US. And that's, so that's definitely helping the landscape for bonds and for fixed income in general.
Yeah, absolutely. Sri, anything to add to that? Just sort of the international story here.
Yeah, I mean, I guess, more broadly, I think that we're starting to see, as Lee mentioned, higher interest rates to have an impact. When you mentioned ex-US, the US landscape seems to be a little bit divergent from a lot of other economies around the world, and you're starting to see central banks generally start to bring rates or sort of talk about bringing rates down. You've got the ECB recently talking about how they will expect cuts to come soon. The Bank of Canada, while they haven't explicitly stated anything, are on the cusp of likely cutting rates, and I know we'll get into that in a minute. So I think that everyone's looking sort of to domestic economies and starting to see some pressures from higher rates, and so that is kind of the broader landscape. But yet, globally, so I'd be remiss if you left out, what's going on in Japan too, where we're actually going a little bit in the other direction, and that has implications as well for global investment flows as well.
Yeah, and the currency. I mean, we got to get into that question. Okay, all of those things to come for sure. Lee, we've heard reporting from many of the big banks in Canada, and they have their own views on the interest rate story. It's obviously hugely impactful to all of them. Also, OFC putting out a report talking about lots of things to do with the mortgage market. I mean, one of the messages that's come out of one of the big banks, and probably other people, I just want to get your views on, is this idea that even if a cut was to come tomorrow, it's going to take some time to filter through, which maybe we forget.
Yeah, it really is. So I mean, the OSFI report highlighted the fact that there will be there's a reset wall that's coming in 25 and 26. So it's already started for people that had mortgages that reset earlier, but we're seeing a reset wave that's going to be coming next year, and we really need the bank to be cutting ahead of that. Otherwise, that's going to have a pretty major impact, a disparate impact on certain individuals, and so it's going to hit some people pretty hard. Some people will be okay, but we do think that the bank is going to need to be cutting into the next year to get ahead of that.
Okay, and Sri, let's just ask you straight up, do we need a cut in June? I mean, we're days away from this meeting. Must it be June to get ahead of that?
Yeah, no, it's interesting. We were actually discussing this just earlier this morning about whether June or July matters in terms of, I guess our opinion on that would be that, whether it's June or July doesn't really have a big impact in terms of the broader impact to the economy, because, it's just a few weeks apart. That being said, I think where it is a bigger impact is the message it sends, and how the Bank of Canada follows up with it. So, if they cut in June, there's maybe an element of a little more urgency, and also depending on how they justify that cut. If they choose to wait in July till July, then maybe the market takes that as a little bit, okay, there's no urgency from the Bank of Canada, but they are on this path to cutting rates. But I would caveat that with saying that the next meeting is always kind of the focal point. And as soon as it happens at whatever meeting it happens at, the market has a tendency to interpret that as an urgency, and that it's a string of rate cuts coming down the road.
So let's go into, Lee, I'll begin with you on this question. We may go at it from a couple of different angles, but so let's go into essentially the housing market in Canada, and then this is sort of going to the economy and ultimately what you're looking for in terms of bonds to make all this work. But we're going to the economy here. A cut, in theory, could boost the housing market. To what extent is that a balancing factor overall?
It'll boost the housing market to a certain extent. So it will lower overnight rates. It would have an effect on term rates. So if you're getting a 5-year mortgage, then that's going to help you a good bit. It will be a little bit of a tailwind. The other side of it is that we have a structural deficit of housing in Canada. That's not gotten better, and we've had a lot of immigration, and that's only exacerbated the problem. So house prices are probably not going lower. They're probably going higher, and that's the risk to all of that.
Yeah. Anything to add there, Sri? Just sort of.
Yeah, I mean, I guess we have a tendency to focus on housing, but I would also add that a cut also has an impact on the corporate sector, for example. And there's a lot of sort of pent up investment demand or investment decisions that have been on hold, given sort of the uncertainty about the rate environment and higher rates. And I think if you start seeing rates come down, or even people have confidence that things have stabilized, it allows corporations to plan a little bit more in terms of CapEx and spending and investment. And so I think if you start to see cuts, that's something, the balancing act that the Bank of Canada has to play. Like, yes, there's reasons to cut because of the pressure to consumers in terms of housing payments and discretionary spending, et cetera, because of how much they're spending towards their houses. But at the same time, not only do you risk fueling housing, but also you will end up encouraging investment once rates become more attractive to companies and corporations. And so that's another element that the Bank of Canada has to balance, in that could be another boost to the economy as soon as rates start coming down.
And Lee, I'll just add in the currency question. It should make the Canadian dollar drop. Is that useful?
It sure does. I mean, that will limit the amount that the bank disconnects from the Fed. So the bank will need to cut less, and a weaker currency will definitely help the broad economy. May not help everyone, as we said, disparate impacts, but it will help do the bank's job for them.
We'll circle back to this, and I suspect you've got a couple questions on this along the way. I just wanted to go to what looks like an interesting investment to you right now. Where are you seeing issuance? What are the provinces doing? Maybe the oil producing provinces. I mean, there's certain have and have not provinces that I'm sure you invest in carefully. But what do provincial bonds look like to you right now? Are they an interesting investment?
Sure, you want me to start? You want to go ahead?
Sure, go ahead, Lee.
Well, I would say, Pamela, that we do favor provincial bonds over higher quality long utilities. We think the spreads there are relatively attractive. We did see a bump up or wider in provincial spreads into the first quarter when we had provincial budgets come in. They came in a good bit higher. They were expected to be higher, and they came in higher than that. That had an effect on spreads. So we're seeing provincial issuance that's come in quite a bit higher than what we thought. Having said all that, the provinces are pretty sophisticated issuers. They've done a great job of going overseas, so they haven't slammed our market in the way most people were expecting, and that's brought
they're going overseas. Back in. Did you say? They're
that's right.
They're funding overseas. Okay, they're issuing where? U.S. or Europe?
All of the above. So if you look at just Ontario, so the last time they did a non-CAD deal would have been in May of 22. And since then, they've done 3 or 4. They've done about 6 million CAD equivalent in the U.S. alone, just this calendar year. So that's taken a lot of the funding needs out of Canada. And we look at that, and we're a little bit sad that they didn't come to our market. We'd like to see cheaper bonds, but at the end of the day, they're pretty good issuers. And so that's helped support provincial spreads and also reinforced our thoughts around it.
Yeah, Sri, anything to add there, or is that pretty much?
Yeah, no, I think that sums it up. I think as a whole, I think when we went through provincial budget season, the budget deficits were a little bit worse than expected, and the numbers, the issuance numbers and deficits were worse than, we're sort of on a path towards trending to getting worse. But I would say that all in, you're looking at deficit spending of about 1 to 2% of GDP, or deficits of 1 to 2% of GDP. And if you look at where the provinces are spending, it's in many cases for a number of the provinces, it's infrastructure spending due to deal with immigration, migration, and sort of improving infrastructure and housing and things like that. And so all sort of areas that are definitely needed, and while sort of the higher deficits and increased debt levels are concerning in a higher interest rate environment, I would say that overall things are somewhat manageable, and on a relative basis, we're also looking at the market from a valuation perspective, and a lot of that is relative to where corporate bonds are. Provincial bonds actually look fairly attractive.
Interesting. Is there any, we talked about this years ago, I feel like, when there was lots of discussion of office and what was going to happen, and the commercial real estate story. Are there any funding requests or suggestions or conversations going on about sort of flipping some areas of office into something that's more residential for cities struggling with the residential building situation for housing?
Yeah, I mean, I think there's definitely conversations around that. I think when we talk to our sort of real estate analysts and look at the market a little more closely, the tricky thing is conversion of office to residential is a really difficult thing to do, because if you think about the footprint of an office building and what you would need for apartments or condos, if you think about, an office has like you just think about where you put the plumbing and sort of like the way the windows are set up, and the big floor plate of an office building makes it really challenging and expensive to do a conversion into apartments. So while there are certain buildings that it can work for, it's a real challenge for that to happen in any large scale. Really, I think where you may end up having to go with that is looking at sort of older office buildings that may actually need to come down and be rebuilt to some extent. But of course, that it comes with added cost, et cetera. And so while that's being contemplated and discussed, I don't know at this point that that's really seen as a feasible sort of solution to sort of the shortage of housing that Canada faces.
What area of real estate, maybe I'll put this to you, Lee, is of interest, or, are there areas that I'm sort of thinking more on the REIT side of things, basically?
Yeah, so in terms of our exposures, if you think about the larger retail REITs that have strip centers or strip malls that are grocery anchored, so for example, that have a Loblaws or a Sobeys or a Metro or sort of large grocers and have banks and liquor stores, or a sort of necessity sort of based retail that everyone has to go to, and did well even through the pandemic, for example. So if you think about places like that, those are strong cash flowing real estate operations, and when people have this fear on real estate, so everything kind of was treated with the same brush and have been hit hard over the last few years because of just being exposed to real estate and concerns, which really were more related to office more than anything else. And so there's a lot of opportunities in segments like that. Industrial is also another area that has performed quite well over time. It does face a little bit of headwinds now when you think about it more through North America and globally, that there are some supply coming on. And some companies have stepped back from needing some of that storage and industrial space. But that's also been a sector that's held up relatively well of late.
What sector are we talking about when we're talking about land, property, real estate for data centers? Does that fit into industrials? Does that fit into, is that almost a telecom story, or where's that fit? Because that's obviously going to grow.
Yeah, I mean, it is growing, and so that's industrial is normally where we see that. So you've got some diversified REITs that have that exposure. You've got industrial REITs who specifically focus on that. But that is, that has been a growth area. We've actually seen some REITs that have divested that to get back to more of their core competencies as well, though, because the as you can imagine, those buildings are worth a lot right now, especially in the context of their broader portfolio.
Yeah, fascinating. So let's go into some of the sectors a bit. We talked a bit about provincial done real estate. What about sort of financials are very much in the discussion right now because the Canadian financials are reporting, but also telecom, some of the other areas of the corporate market. Lee, why don't you begin, please?
Yeah, I mean, you hit on the two sectors that we've spent the most amount of time thinking about. So we've spent the broader part of 2 years over with the financial sector. We thought that that their spreads didn't reflect the quality of the asset class, and we were seeing spreads on energy and industrial substantially tighter or lower rated credits that were at the same spread as we saw financials. So we've been overweight financials for the better part of 2 years. That has worked very well, but since then we've seen financial spreads sort of normalize relative to the rest of the universe, and probably the largest underperformer. And this means that it hasn't tightened as much. Spreads have been tightening quite a bit over the last 6 months, but cable telecom has underperformed the broader sector, and that probably has more to do with the fact that Sri and I were talking about this yesterday. They have large capital programs that they just need to spend money, and they tell us they want to be sub 3 times leverage, but they stick at 3.25. They've been doing that for a decade. So that started to weigh on the sector. And then also we've seen the acquisitions in the sector, mergers. And so that's brought some supply into the market. That's pressured spreads. And that's been working out nicely for us as well.
Okay. And so, sorry, are the financials still of interest to you right now or less so?
Yes, but we've reduced our overweight.
Okay. Sri, anything else to just sort of game out the positioning that you can leave investors with? Like what is your positioning? We've spoken about some components of it, but give us the map.
Yeah. So I think broadly, if we think about overall, when we look at corporate spreads are relatively tight by historical standards. However, they still offer very attractive yields. And so if we look at the broader landscape, actually, I should probably step back and think about our overall sort of view on fixed income. But generally, where rates are, we're looking at post the global financial crisis in 2009. We're looking at yield levels that are at some of the highest level percentile levels. The Canadian universe is at roughly the 90th percentile in terms of yield levels. And so fixed income more broadly looks attractive, and the risk reward, if you think about an up and down move in rates by 50 to 75 basis points, you're generally going to look at positive returns over the course of a year. So even in a worst case, sort of if rates were to go up, combination of rates and spreads were to rise by 60 to 70 basis points, that may sort of erase your coupon income and your yield that you've gotten over the course of the year. But the flip side is if they drop by that much, you're going to double your returns and have roughly an 9% return on bonds.
Repeat that. What percent return? Yeah.
Yeah. So, well, I guess the sort of rough back of the envelope. I mean, don't quote me on this or hold me to exact predictions, but if you look at the average sort of if you think about our bond fund yields roughly 4.5%, 4.6%, and it has a 7-year duration. And so if you think about the math on that, if rates were to go up 60 to 70 basis points, that would be a price drop of about 4.5%, and it would wipe out your returns for the year. However, if rates fall by that much, you essentially add another 4.5% to your yield, and so you're roughly ending up around 9%. And so, if you go back 2 years ago, that risk reward on a rate move like that would be largely negative returns, which we saw, versus very small positive returns. So now you're looking at, through the course of the year, the very high likelihood of having positive returns when you look at a risk reward scenario on fixed income. And so with that as a backdrop, we also, and then when you go into sort of more sector specific, corporate spreads are trading through historical averages right now, long-term historical averages. But as I said, the yield on them still remains attractive. And so the opportunity cost of not being invested in corporate bonds is quite high. But that being said, you're getting most of that yield from government bonds. So while we still do like corporates, our exposures are much more specific to idiosyncratic names and sectors that we like. And our overall risk to the corporate market is probably on the lower end of where it's been historically.
Amazing. There's a question coming in, just comparing, going back in time to the 70s and 80s when rates were higher than they are today. What makes this moment in time so different? Yeah, Lee, let's put that to you.
Well, so I mean, the short answer is we think, and the market's pricing is that we're on the backside of this inflation spike. We're seeing inflation's come down a lot. We're not at target, but it's come down a lot. The rate of change has slowed recently, and that's really what's caused a lot of hand wringing in the markets about how much the Fed and the bank are going to cut. But that's the backside. If you think about if you bought a bond in the mid to late 80s and what it did over that horizon, it did pretty darn well. Our rates right now are probably closer to the rates levels we saw pre-financial crisis.
Yeah, for sure.
Yeah.
So let's go a little bit to I think this ties into what you were talking about a bit, Sri, a minute ago, but just that longer term, shorter term inverted yield curve, kind of the sleep at night element. I mean, we've got this inverted yield curve, and bonds are meant to be safer than the equity story. I mean, what do you want to kind of have people know about this as a piece of their portfolio?
Yeah, I mean, if you think about the yield curve right now, it's been inverted for much longer than it has been on average in historical periods. We do think that could persist for the time being. That being said, that over time, as rates come down, as the overnight rate does come down, we will likely see the yield curve steepen. I think you have to have some patience on that. We would have, if you go back a year, we would have expected that to have kind of played out sort of by now, but the backdrop has changed considerably. And so I think that inversion can persist, but we are taking the view that ultimately that curve should steepen out. And in the meantime, also, given that we have that inverted curve, we think that short to intermediate bonds, especially corporates, are probably more attractive than longer dated because you are actually earning more yield and have shorter exposure. And so our corporate positioning tends to be on the shorter end of the curve where you're protected against volatility and have that yield and spread cushion. And then, as we mentioned, we like provincial bonds and the valuations out the curve, and that's how we offset sort of our exposure when we have more choice, was we're buying provincial dated bonds out the yield curve. I think the way that we're favoring kind of that short to intermediate part of the curve and tend to be underweight out the curve just because of that inversion. And in the meantime, that's adding positive yield to a portfolio as well, given the shape of the curve.
So with the Bank of Canada in your mind, Lee, and the rumored cut, maybe the expected cut by many people, what's sort of the pitch for Canada? How does Canada look? We started out sort of looking at the global rate story, or at least sort of the developed markets rate story. What's the pitch for Canada right now based on?
Yeah, certainly we like credit spreads in Canada versus the rest of the world. So if you look at where we are in spread terms versus the U.S., we're substantially wider. And so for some of our core plus funds, that meant that we've been limiting or reducing our U.S. exposure there just because Canadian spreads look a lot better. And so from that perspective, we think it's pretty favorable. And if you look at Long Ontario at 90 over, you look at a state in the U.S. or you look at a long utility, those spreads are going to be substantially tighter. For a lot of reasons, we think Canadian spreads look attractive here.
Interesting. Sri, do we absolutely have to cut in Canada?
I wouldn't say not currently. I think that there is still some there's still some doubt in terms of central banks' views on when the right time is. If you think about where inflation is more recently, the 3-month averages of inflation are well within the Bank of Canada's band at roughly around 1.6%. But if you think more broadly about the longer term headline, we're still hovering around the top end of the Bank of Canada's range, right around 2.7%. And so I think that, Tiff Macklem's made the point in the past that they'd be much more comfortable if inflation was in the middle of their band, because if there's a mistake made, they have some room for inflation to go back up and stay within their band. But if they're operating at the top end of that band and they make a mistake and cut too early, then they risk inflation going outside of their band a lot sooner and a lot quicker. And so then they would have to reverse course. So I think there is a bias for them to hold off as long as they can. But obviously, we have to acknowledge that there are some risks looming, especially as we get into towards the end of the year and next year with a larger proportion of mortgages resetting. And so I think eventually we will need to, but I don't know that it's necessarily an imminent need. And I think what the market's come around to, which is a little more reasonable now, is that the pace of those cuts don't need to necessarily be as quick as everyone had priced in at the start of this year. And you can see that in that, at the start of the year, we priced in 125 to 150 basis points of cuts through the year. And now we're looking at only a couple, 2 to 3 sort of within the next six to 9 months.
That's the lead sentence of this interview. The pace doesn't have to be as fast. Lee.
Yeah, Pamela, I'd add to that. So, to Shree's point, if they cut in June, if they cut next week, then that probably sends a signal to the market that they're concerned. Whereas if they wait 7 weeks and cut in July, they're going to have 2 more inflation prints to look at. They're going to have a lot more certainty around the path of inflation. And so that, that would be the reason that if they cut next week, that they're probably a little more concerned.
This is a really exciting interview. Great to see you both. And thank you very much for joining us, Shree and Lee, on the Bank of Canada, where it goes from here. All the best.
Thank you.